first and foremost, certainly over the last 6 to 7 weeks, and probably even for those of you who came to my webinar session last week, thank you very much. And certainly appreciate all the support. So much support. In fact, this budget breakout session blew up my Zoom meeting, so it was oversubscribed. So one of the things is I'll be recording this and releasing it very shortly through ilovesmsf.com a little bit later on. One of the key features, though, that I'm certainly getting on top of, and I can tell you generally my strategy in relation to any legislation, and we have to remember last year and this year alone, we've got more than 900 pages of amending regulations, amending laws, amendments to the amendments. There's, as we talked last week, there's even those new LRBA draft amendments which will be coming in. Now, obviously, with this budget, we've got a few things that impact our SMSFs. Medicare levy is going up to 2.5% from 2% to cater for the National Disability Insurance Scheme. I don't know why they don't call it a tax. Effectively, it just keeps on going up and up as far as I'm concerned, which is pretty crazy. The other one that we've got is we've got quite a few matters around the first home saver scheme, which I'm pretty excited about and the way it fits in, and certainly it looks as though it's going to be very difficult for what I would say industry and retail funds to abide by the rules. But then from self-managed super funds, there's going to be some great opportunities. I've found a couple of points that I want to raise with you. And of course, the big blowout, which I'm not sure how the take-up will be, but we're going to go through the actual fact sheet on the downsizes, particularly because it blows against all our rules in terms of the I suppose contribution rules in part 7.04 of the SIS regs. It blows them out of the water, changes all the non-concessional rules around 1.6 and all that, so it's all A-OK. So one of the things we're going to be looking at today is just the broad view of the budget. As I said before, right from the start, it's taken me a good 6 to 9 months in order to get through a lot of this sort of stuff and get on top of the legislation. And even this morning, I've been looking at, sorry, my slides are getting in front of me, getting too excited. There's so many of you on there. But essentially, from my perspective, is that there's a lot of stuff, and it takes me at least 3 or 4 times to read a consolidated version of the legislation in order to get it to even make sense, then compare it to what the tax office put out in their LCG guidelines, go back and read, go back into all the various regulations in detail, go into the definitions, come back and then start to apply it, look at the tax office cases, look at the EM cases, examples, and bring the whole thing together. Now, there's such fundamental changes from the simpler super rules that were introduced in on the 1st of July 2007, it makes my head spin. And it's only been, and I have to be brutally honest to you, it's only been the last maybe a week that I've really got on top of things, particularly when it comes around to death benefits. And thank you to Kerry. We talked about her last week, and also we've got a couple of other ones that I've got on the books where people have died and they're working out what to do exactly with their death benefits. And I can tell you it is not that easy. But I've also found a couple of really juicy loopholes that I will be out and about on the 19th of May. So the 19th of May, if you haven't booked in for that, please feel free to do so. I've kept the price for face-to-face. If you can get there, look, it's absolutely crucial. I'll be giving you all attendees on the day. You'll be getting a hard copy of all the amending legislation, regulations, and all that stuff, because it's not in the 2017 CCH super legislation. So we're going to be going through marking it, annotating it, updating it, putting in strategies, noting it on the side. So it's going to be a really hardcore. If you're not used to looking at legislation and, more importantly, are going through the process of implementing, reading, understanding, applying, then it's probably not for you. But certainly, if you want to see how the really big boys play, then it's absolutely crucial to come along face-to-face or get to stream live. Not everyone can make it to Melbourne, and who knows what the weather in Melbourne's going to be at that time. This is, as I said, this is on the internet, so if the sound is a bit scratchy, it's probably may well just be your computer. I've had feedback that it's coming through from most people, so we'll go on with it. But one of the things that I want to start on with is see if you can make it to the 19th of May. But remember, strategy, execution, and success. So I'm going to look at a few strategies today. In fact, the government's given us a couple of strategies for housing affordability. They're also starting to chop into the foreign ownership as well, which seems to me to be one of the big issues. I remember a couple of years ago going out in Sydney looking for apartments, which were valued around about $2 to $3 million, and getting outbid by 21-year-old Chinese students who obviously were there buying for relatives back in China. But notwithstanding that, the market's gone up and the government is doing something about it, so to speak. But they've given us our strategy. Execution of what we're about to look at is important. The same way all the estate planning stuff I'm looking at, all the new ideas of retirement phase superannuation interest, retirement phase superannuation income streams, pension reserving, which is even more importantly now, estate planning reserving, which is probably God's gift to us at this present point in time in terms of self-managed super funds. All of these things, in order to execute it, must be shown in the governing rules of the fund in your trust deed. And at this present point in time, I think most people would say that your trust deeds need not only to be upgraded, really trust deeds should have been drafted again for all of these rules, particularly to cover all these various interests. And likewise, I would say that if you are going through an upgrade process at the moment, to make sure that your trustee provider also gives you an absolutely free upgrade, because both the first home saver and in particularly the downsizer, because it blows apart and goes against all the rules, effectively means those deeds will need to be upgraded probably within the next 6 months once we see the legislation. But in order to get the strategies right, we've got to get all the governing rules, the execution, and then we have to be success. Scary thing about it is that advising a client or an individual, a youngster, on the first home deposit, putting contributions into super, you will need to be licensed in order to do that. Likewise, putting super or downsizing the house, you're going to be not licensed to do that. So accountants and administrators are unlicensed. Absolutely, you can help in the execution. But if you start talking about it, all hell could break loose. You're going to need to do a statement of advice around it. But anyway, let's move on. Strategy, execution, and success. I think I tweeted out yesterday that I didn't think there was going to be any changes. I don't know about you, but I'm suffering reform fatigue. There's only so much knowledge I can get together. When you're pulling it from all different sources, it takes a long time to bring that into play. But look, I'm on top of it now. Now I'm seeing all the opportunities, and really for me, super and self-managed super funds is the most exciting time it has ever been. It is not the golden age of self-managed super funds. That was 2 years ago when we had borrowing, virtually no tax rates. Now we've got tax in play, which for us, it's the golden age of SMSF advising. Or if you remember from our website our webinar last week, it's the golden age of family wealth advising. And I say that because of the way the estate planning works. For some of our clients, particularly ones with big balances, it is absolutely crucial to put in place a family trust and a self-managed super fund. So using an SMSF in isolation is no longer the case. We're going to have family trusts and family super funds running side by side, and now Family Wealth Advisor is going to run for that. What worries me though is now super is being used for everything. And I do like that the new changes are also offered to industry and retail funds. They haven't been highly targeted to self-managed super funds like the budget last year. But last year, the desire there was to obviously increase the revenue coming from self-managed superannuation funds into Federal Treasury, although at this stage we are still in a negative position, meaning that self-managed super funds take more than they give, and that will be the case for some years now. But super is actually being used for everything else under the sun. I was surprised they haven't given out infrastructure bonds for the Sydney airport. Mark my words, anyone from the government looking at that, why don't you do an infrastructure bond for self-managed super funds? The state government and even Sydney airports have binned you in terms of putting money into it, but it's absolutely crucial for Sydney airport, particularly a frequent traveller such as myself who goes to Hong Kong, Singapore, Thailand, sees all of these countries with great airports, and we're stuck with an absolutely crazy one that's our botany. I love it that it's so close to the city, but gosh, there needs to be a bit of work. So here at first from Grant Abbott, don't be surprised if we see some Sydney airport infrastructure bonds coming out later on, which will be prime for self-managed super funds because they'll give a guaranteed return over like a 25, 30-year period. Let's face it, that's what they should be doing. But anyway, the government's taken their hat off and turned super to housing affordability. Scary at the same time. I just don't understand this. One thing they're worried about housing affordability, and I've got a question on the thing about LRPAs, and I will be going into this in detail on the 19th of May at our conference. But I just don't understand. One minute you go and say, okay, we're going to come up with these great housing affordability packages, and then at the same time they keep on chipping away, along with the tax office, mind you, chopping away at LRBAs. And more importantly, with the pension transfer balance, including the proportion that relates to the members setting up the pension transfer balance, acclimatising that or putting it into their the outstanding loan balance in as an asset for the purposes of the total superannuation account, or total super balance, which I'm not quite sure how that works, but we'll certainly go through it on the 19th of May. So make sure you come along. It's going to be awesome to go and have a look at this legislation. I'm chairman of the SMSF Members Association, as many of you probably know. Myself and also the board, my good mate Simon Macon, we came out with a model which I promoted, which I thought would be a lot better for the housing affordability. The government today said, well, why don't you guys come up with an idea? So we spent a lot of time, and our idea was that quite often the deposit is going to be coming from the members' parents anyway, if it's not being done so at this present point in time. We find a lot of people who want to get into their first homes need their parents' affordability. Now, a lot of parents, all of their money sitting in superannuation, so why not have a loan? So we have an exception to the in-house assets rule in section 71. We probably have a new subsection, which would be, I don't know, an R or an S or whatever we're up to at this present point in time. And the parent could lend for the first home deposit. It'd be secured by a second mortgage. And of course, it'd have to be market value interest rates. Why not do it that way? And I think that would have been a better way because the money would be available directly compared to where we are now in terms of home depositors. Now, what I'm going to do is I'm just going to slip out of here if you guys don't mind, and we're going to look at the fact sheet. Normally, I would look at the budget measures number 2 paper, but for the first time ever, they've got a whole lot of fact sheets. So let's go straight in here because this is probably the guts of it. Certainly, you're not going to see any of this in any commentary because there's a couple of things that we need to have a look at. So the issue of Australians entering the housing market later in life than previous generations, with housing prices high, difficult saving and deposit key barrier. Maybe they're getting in the housing market later because they can't afford the deposit. But anyway, so from the 1st of July 2017, individuals can make voluntary contributions. Now, these are both concessional and non-concessional. It doesn't seem to me to make non-concessional contributions into the fund, mainly because obviously if you've got that non-concessional out, you'd be using it for deposit in the first place. So you can make voluntary contribution up to $15,000 per year. So that is the gross amount of the contribution I'm expecting. We don't know until we see the legislation. Again, this is absolutely crucial to have in our deed, whether it's the $15,000 or it's the $15,000 less 15%, much the same as we see with superannuation splitting the concessional contributions, or the amount there is 85%. Either way, it shouldn't be a big issue, but we do need to know in order to get success to get our execution right. But all in all, $30,000 in total can be contributed in order to purchase a first home. I'm going to come to you a little bit later on. It doesn't say what age the individual is. And I'm presuming there it's going to be a contribution made by the member directly, not, for example, a child contribution where a parent or a grandparent can make a contribution. Ideally, a parent or grandparent may be able to put in some contribution on behalf of the child, perhaps, but it'd be a non-concessional. I'm not sure the benefit of that, because you're virtually gifting it away as opposed to a loan if we did an amount outside of super. One of the things there, though, is certainly if like me, a number of parents employ their children, then they can help them out by making or letting them doing salary sacrifice out of their package. So remember, the contribution has to come from them, not necessarily the employer. Part of the success around the execution, of course, for that you need to have an employment agreement that allows upfront, the contract allows a salary sacrifice for which the child or the individual must be able to determine what the salary sacrifice component is at the start of the year. That needs to be written in. If it's not written in, then potentially we've got big problems there, particularly if it's a bonus. So $30,000 in total to their super account. Now, obviously, if they're spouses, they can put it together. I query what happens if 4 people get together and all buy their first home. I'm presuming here the first home has to be owner-occupied or meet the principal place of residence. But again, can we go beyond 2, which is the normal variety, to maybe 3 or 4? Again, we're not going to know until we see the legislation. So these contributions tax at 15% along with deemed earnings, and that's a shortfall interest charge, which is the current bank bill rate plus 3%. So there's an assumed earnings rate. Now, if you have a look at a lot of funds at the moment, probably particularly if there's a down market or there's another recession, to get a guaranteed 6% is going to be fantastic. And more importantly, it means there's going to be a drain on the other reserves from the superannuation, because essentially what we're doing is we're building a island account within an existing accumulation fund. So those deemed earnings can be withdrawn for a deposit. So there's going to have to be change to the preservation rules, obviously, for there, and also change the sole purpose test, because how does this fit in with retirement income and estate planning? But anyway, the government has its own fortes and concerns there, supers being used for all. Importantly, withdrawals will be taxed at marginal tax rates less a 30% offset. So if you're in the 30% tax bracket, effectively means there's no tax on the withdrawal. Up on the top level, 45, and now remember, with Medicare levy, 47.5, because it goes up 2.5, then there's going to have to be 17.5% tax payable on the withdrawal. So that's again, that really means it becomes marginal, because if we were up to contributions tax of 15% and then also 15% on the income and then 17.5%, it means we're up around about 32.5. So again, it's for people still, around about that 80,000 or where you're paying 30%. So for most people, the first home super saver scheme could boost the savings and put towards a deposit by at least 30%. So they've done their numbers. They've in fact got a nice little calculator on the budget website that you can use. So not a bad little thing to give to someone to look at. Remember though, I'm not sure what you're going to charge for this strategy, but it certainly will prevent the spruikers going out and about, because dealing with this, talking about making contributions, is, listen to this, a licensed product. You're going to have to, in fact, give a statement of advice. And we've seen a number of spruikers already in jail for being caught for providing advice without a license. So we've got to be very careful about this one. Many employers will be able to take advantage of salary sacrifice arrangements to make pre-tax. Individuals are self-employed, those employers who do not salary sacrifice and claim a tax deduction on personal contributions, meaning saving effectively come out of pre-tax income. And remember, from this one, they talk about salary sacrifice, but I'm presuming there we're also going to make concessional contributions, because we should remember from the 1st of July, 2017, an individual, the 10% rule doesn't apply, so an individual can make tax-deductible contributions into super as well. So I'm assuming there it's not just salary sacrifice, it's individual tax-deductible contributions, much the same as self-employed, which we've got there anyway, which talks about who do not offer salary sacrifice. Voluntary contributions on the scheme must be weighed within existing super caps. So that means the total concessional contributions an individual can make from both compulsory, employer, and voluntary, including those under the scheme, cannot exceed $25,000 in 2017-2018. God forbid if people are well and truly too high in terms of SGC. We've got the 90-day bank bill rate, and then we've got the tax office looking at it. There's Michelle and Nick's first home deposit. We won't go into that, but effectively they can pull it together. I think it seems pretty simple from my perspective. Now, I've got a question here from Mark Fine. Thank you, Mark. We're running pretty short of time. I want to get out within another 10, 15 minutes. But if you contribute $10,000 and 15% of tax is paid by the fund, do you withdraw $8,000 for deposit or $10,000? My feeling is, Mark, that's going to be an issue that I raised originally, is that if we, let's take a retail or industry fund. If I put $10,000 in, then I'm going to end up with $8,500, and that's going to go into my account. Now, remember, I can keep on doing that. And up to my present point in time is that once I hit the $30,000, I can withdraw the lot. So it just means it's going to take longer. But in a self-managed super fund, if we put in $10,000, then $10,000 goes in there. There is no contributions tax per se, particularly if there's excess credits inside the fund. If we have a look at the $10,000, it just goes on, and as Mark has put there, and I would say to all of us, is that this is where the retail industry funds are going to do is, when we come down and have a look at the legislation, does it say that the amount to set aside is 85% of what is put in the salary sacrifice or the individuals making the contribution, or is it 100%? And then it's up to the trustees of the fund actually to make a determination. It'll be interesting. I think from a self-managed super fund, I think it's going to actually be 100%, which is another benefit for self-managed super funds. Another reason why we have family super funds, to get those kids away from retail industry, putting them into the parents' fund. But make sure, much the same as we talk about LRBAs, need to have segregated investments. Doesn't work for tax purposes, and we'll look at that on the 19th, but we need to have segregated investments. So this one is actually going to be completely segregated. But I'll just take you a little bit further from that, Mark, is that let's say that we put in $8,500, we invested in stocks or whatever, whether it's segregated, the market tanks and it's now down at $4,500. What happens there? Well, what do you guys think? What would happen if our capital contribution goes down? Well, my feeling is, and if I was writing the legislation, and maybe they could tap me on the shoulder and say, Grant, come and write the legislation, but certainly I'd be putting in any deed, and you can see why deeds need to be upgraded, is that what I would say from that perspective is that the other, if it's $4,500, the other $5,500, if we're capping it off at 10, actually comes from the rest of the capital of the fund. So in our account balance, we call it our super saver balance for our first home buyers, our super saver balance. We've got $10,000, but it's only represented by $4,500 in cash or underlying investments. It means that needs to absorb other investments. So in a down market, it's not a bad way of getting extra money out of the fund as well. Likewise, what happens if the underlying investment returns there tank, so we don't get any income? There's a deemed earning rate there of the bank bill rate plus 3%. So for me, there's all upside here for the individual rather than the downside. But the contributions are the actual dollar amount of contributions. So let's just go back to the slides. Oh, I'll get back to that little one a little bit later on. So it's above SGC, which is important. And remember, we've got individuals and also employees who want to do it in their own account above SGC. 15,000, maximum is 30,000, but subject to the caps. We've got the first release date is the 1st of July 2018. Now, mind you, they can't make a contribution until the 1st of July 2017. So effectively what we'd be looking at is 15 for this year and then another 15 from the 1st of July 2018 and then withdraw it maybe on the 2nd of July 2018 to buy our property. So I don't know how that's going to impact our housing affordability in between. As I said before, we've got the earnings. We talked about the withdrawals at marginal tax rate. NCCs don't make sense unless a parent or grandparent. Doesn't have any age limits, so it looks as though you could do it for a 10 or 12, or more importantly, like a 16-year-old child to get in their first home. Crazy, but I've seen it done before. And also doesn't seem to have residency limits. Remember, for self-managed super funds, it's still not a factor. We could have a non-resident, but what we're going to do is see what the qualifications are when we have a look at the definition of who is a first home buyer or who it limits to. Maybe residency will come up. But it certainly can hear the screams from the big funds already. Thank you for that question before, because essentially what will happen there, can you imagine the amount of administration changes going to have to be made, even for class super, BGL, and also super concepts. This is going to be an absolute nightmare in terms of administration. But it doesn't matter. Those guys have got huge amounts of programmers making lots of money, so they should be okay. Let's move on to the next one, which absolutely blows me away. And so that's not the first home depositors, but I've been thinking about this for my mum, and this is my new name. And thank you, Liam Short, for this one. This is a bit of an in-house. So there's a bit of a typo about older trustees. And Liam said, well, the typo is rustees. So we're calling these older people who are trustees of self-managed super funds rusties. So sorry to be disrespectful, but I thought that was very funny. And credit Ashley Jarman for that one, my girlfriend, who made that mistake. But anyway, what we can do is contribute up to $300K per super fund for member for disposal, principal, place of residence. Again, I'm not going to just give you my stuff. Let's have a look at what the fact sheet is. And mind you, as I said before, we're looking at a fact sheet. There's a lot of legislation that has to change there, and plus we have to make sure that in our execution is going to be important. But the issue, being unable to invest the proceeds of selling their home into superannuation discourages some people from downsizing. This means many larger family homes sit occupied by only singles or couples. Encouraging downsizing should enable more effective use of the housing stock by freeing up larger homes for younger growing families. Now, first and foremost, I think certainly having got my mum, a lot of parents want to stay in their family home. But at some point in time, obviously aged care knocks up. But what we're doing here is the other fundamental is that at some point in time, cash starts to dwindle and the lifestyle gets to be severely compromised by being in that property. To free up that property, it'd be okay, but we're going to have to downsize. So look, it's not a bad deal. In fact, we're starting to see a lot more downsizing, particularly in Sydney and Melbourne, even Adelaide, my hometown, where people are selling up their larger homes and moving into the city to be close to all the action. Although, sorry guys, in Adelaide, I don't think there's much action in city, in the city anyway. But when we have a look at that downsizing is great because it starts to free up that housing stock. From that perspective, though, is with current interest rates, particularly for the elderly generation or the rusties, we call them, they tend to want to go for lower interest rates. If they still remain their income stream, then what we've got from there is we've got a position. We've got a position there as well in terms of. Sorry, I just got a question from Brenda. I'm trying to do two things at once. That's how quick my brain is sometimes. Brenda's actually got a question there. Does this include people going into retirement homes? Yes, it would. One of the things there, Brenda, that's a good question. I've had to face it personally with my father. I'm going to be looking at a lot of this on May the 19th in a couple of the legislation. But essentially, when we downsize, that $300,000 can be put into a superannuation fund. More importantly there, we could also put it into a refundable accommodation deposit, which can't sit inside a superannuation fund. So what we've got there is a scenario that we can put it into super and then pay the daily accommodation fee. which probably is going to be a better way of going about it. So that's around about, I think, a 6.2% based on whatever it costs you to get into the aged care facility on a daily basis. So if your returns are better, sometimes it's better to actually do it by way of that measure anyway. Retirement homes themselves, you can't necessarily buy an off-the-plan retirement home. But if you can, then I'm presuming they're the downsizings there. They're not looking at where the money goes into. They're looking at whether it's a permanent place of residence. But again, let's have a look at that great question to see what the legislation comes out. If we go into aged care, is that classified as a downsizing, enabling us to use a $300,000? For example, if we have a look at someone who might be 90, never put money into super before, potentially if they downsize, they can put their first money into superannuation. I want to look at a lot of that on May 19th, particularly around reserving and stuff like that. So the question is, and it's a really great question, is if they downsize straight into aged care home, will this provision still be available, or they have to go into another home? So let's all make submissions to the government to make sure that effectively it also includes aged care facilities. So we've got a bit of time because from the 1st of July 2018, so that means obviously there's going to be a lot of law, a lot of changes around that time. People aged 65 and over will be able to make an NCC, non-concessional contribution to their super, up to $300,000 from the proceeds of selling their home. The existing voluntary contribution rules for people aged 65 and older, so that's your work test, there's no contribution to those aged over 60. And remember restrictions on NCCs if you've got total super balance, which includes, remember we looked at that last week, accumulation and also your current value of your pension. So over 1.6, you can't make any NCCs. They are also going to be reduced. So those rules, the contribution rules, thrown out. The new rules in relation to NCCs, if you're over 1.6 million, thrown out in terms of downsizing. Make a contribution at age 110 if you're still alive? Absolutely. So it seems to me this is pretty exciting and opens up a huge Pandora's box. So I'm still going to take a while to get my head around it, but look, I've only been on top of it for the last 10 hours, but, really excited about this sort of stuff. So this measure will apply to a principal place of residence held for a minimum of 10 years. Both members of the couple will be able to take advantage of this measure for the same home. So that's $600,000 per couple, which is pretty sizable. Dad's in a home, mum's in her home. So $600,000 from the sale of their property would really significantly boost their super and more importantly, would give them a really good ongoing income stream as we go down the track. Also downsizing, another one is if we do downsize, is it just simply based on the sale or can someone go into a rental property? Because downsizing doesn't mean you're necessarily going to go and buy because it doesn't make sense anyway, because why buy from one stock to another if you're trying to get rid of or you're trying to help housing affordability, bearing in mind, of course, that downsizers generally go to apartments, which are also beneficial for first home buyers. So they seem to be twisting each other at the neck there. So when we go through, these new contributions will be in addition to any other voluntary contributions that people are able to make under the existing contribution rules, concessional and non-concessional caps. So we can still potentially cover those for people between 65 to 75. Now, the measure will encourage some people to downsize in their housing. Now, there's another little thing in here where, okay, this is where things get nasty. Will sales proceeds contribute to superannuation and this measure count towards the age pension assets test? Yes. And that to me is the big, scary elephant in the room, is that where we've got our family home that is exempt from the age pension assets test, and then to suddenly put it in and get it tested by bringing it out is going to have an impact on Social Security. And you guys, look, I've dealt with a lot, and even my mum who keeps on begging me to get Social Security for her, even though she takes out $150,000 per annum. From that perspective, is Social Security is really important to these people. Lose a dollar and they won't downsize. So it's going to be tough yards, but again, model it out, see the benefits of doing it, and should be okay. Last couple of questions here, or questions and answers. Will contributions made on this measure be exempt from the transfer balance cap? No. So if you hit the cap, that's it. It's all over. You can't put any more cap in potentially unless it's gone down the track. So I'll have to stay in the accumulation side. Will the 1.6 million balance threshold for making NCCs also apply to special downsizing cap? And that's no. So that's one of the big changes to the rules. So for me, just in that quick smash out, I think there's some pretty exciting things there, particularly for the rusties and also for the first home buyers. Again, the age pension, worries me. And there's a lot of other things coming, particularly around the Essex space, the eligible startup innovation companies. They're still pretty beneficial there. Obviously, I'm jumping around. Still great news for accumulation funders who are not going to be first home buyers. So for the SGC component, look at Essex Investments, where there's there's a 20% tax offset. And sorry, I'm jumping around. 20% tax offset and no capital gains tax for the first 10 years. Early stage venture capital limited partnerships, exactly the same one. Crowdfunding draft laws are out, so that enables $10,000 per investment. So your crowdfunding will probably also be Essex Investment as well. So expect to see a few platforms. That's pretty exciting, the crowdfunding space as well. So that was a couple also big, a little bit of tweaking inside the budget as well. Final one is make sure you come along to the 9th of May in person or streaming. My book there, I've been working, my book there, I've been working really hard on it for the last 6 months. I've just been getting into benefits at the moment. I've already done the tax, and now I'm going to have to change estate planning a little bit around all of this, because it's not much good for those rusties putting money into super and not having a good solid estate plan around it because they're so close to it. Don't forget to fan my Facebook page. We have daily strategies running. Anyway, that's enough for me. Thank you for everyone who raised the questions, and Mark and Deborah. And also from there, if you've got any questions, just send them to me at grantley2000@gmail.com. So it's grantley2000@gmail.com, while I get my SMSF.com email up and running. And particularly for those of you who are faced with a lot of issues between now and 30 June, we're going to go through some really interesting and way out there strategies on the 19th of May. Anyway, it's Grant Abbott just signing off. Thank you.